All right, welcome back inside our proactive newsroom. And joining me now is Skyler Weinand. He is the Chief Investment Officer for Regan Capital. And Skyler, it's good to see you. How are you?
Good. Thanks for having me on, sir.
Yeah, excited to talk about a number of things around the world. But first, maybe a great opportunity for you to introduce yourself and what you do at Regan Capital.
Great. I'm Skyler. I started Regan about 14 years ago. I've been in the fixed income business for almost 25 years. Regan runs approximately 3.6 billion in U.S., primarily in fixed income. We have four different 40 Act vehicles, a mutual fund, two U.S. based ETFs, as well as a new UCITS ETF that's available for non-U.S. investors. But our primary focus is on mortgage-backed securities. U.S. mortgage market's approximately $50 trillion. Mortgages are about $13.5 trillion outstanding.
Wow.
So you have a very, very large fixed income universe, the second largest market in the world next to U.S. Treasuries, which up until recently is really hard for the end user to actually access. You can't just go onto your brokerage platform and buy a mortgage bond, but you can buy a
Yeah.
40 Act fund that focuses on those mortgage bonds.
Yeah, I'm sure a lot of people are always interested in interest rates and where things are going. What are you seeing out of what may happen with interest rates?
Yeah, it's been a quandary. When you look back the last 50 years or so, you have these time-held, uh, you know, uh, variables or happenings. Let's say the 2 to 10 year curve inverts and disinverts, and that pretends a recession, right? And that hasn't happened yet. So the Fed has lowered interest rates 175 basis points over the last 14 months, okay, 15 months since last September. But the long end of the curve, 10-year, 30-year treasuries have actually risen in that time frame. Mortgage rates are actually higher today than they were last September. So one of the things that the government and the Fed are that's trying to combat, which is borrowing costs, and mortgage rates, have actually gone up since rates have come down. Okay, so the market is anticipating another one, maybe two Fed cuts in the next year, but the jury's out on what that is going to do to mortgage rates in the long end of the curve. And our thought process is more of the same. If the Fed cuts a couple more times in 2026, that along with the stimulus that the government's putting out is going to increase rates on the long end.
Yeah. Let's take politics out of this because
Sure.
when it comes to the Fed, you want to take politics out of it because that's another game we're not interested in discussing right now.
Oh yeah.
But you just brought up a really good point. I want to ask you more about that. The fact that there are so many variables when it comes to raising or decreasing interest rates, and that's the challenge is trying to see which way the winds are blowing as far as whether or not what you're doing is going to have the desired outcome.
Yeah. And you started off with taking politics out of it. And that's the first thing I tell folks is you have these large wild cards out there that I can't predict, right? I have
Yeah.
no idea what the government or is going to do or step into. But what I can look at is the economics of look, the consumer and U.S. corporations have more dry powder in aggregate than they've ever had in history. Financial conditions are very, very loose. The stock market's up over 100% in the last 5 years. So all things point to the Fed potentially raising interest rates. Okay. And if you look at that curve, what the Fed is potentially going to do, the market has them lowering rates a couple times and then rates going back up to where they are right now over the next 5 years. But look, mortgage rates are still high at 6.25 to 6.5%. That is moving into names like Oracle, CoreWeave, these AI companies that are starting to sell 20, 30, $40 billion in debt. Their borrowing costs are increasing. Google just issued a 50-year bond at 5.7% coupon. Okay. That's actually a pretty juicy coupon for a very high quality company. So some of these companies, especially companies that are struggling to pay their bills currently, are going to run into more issues as inflation reignites and rates potentially go higher over the next year or two.
And that obviously takes out of, geopolitical issues that happen around the world and what may happen country to country as well.
Yeah.
I'm just wondering how, for your advice for the average person at home that, as you mentioned, taking a look at those type of bonds and what they may want to look at. Is it having a trusted a person like yourself or their advisor to sort of help them navigate their way through it? Because it can be a challenge for people as they try to make sure they try to secure their future.
Yeah, historically speaking, on the equity side,
Yeah.
indexing and buying the large swath of indices out there has grossly outperformed active management. Okay. And fixed
Mm.
income is the opposite. In fixed income, you're not going to have a 20 or 30 bagger. You're not going to find the next NVIDIA. The best you're hoping to get back is par. Okay. Without a ton of volatility. Okay. So, in layman's terms, what's my advice in the next year or two? Stay short. You're still getting rewarded to be short duration. But there are options in short duration, especially floating rate paper, like United States government guaranteed mortgage bonds, where you can get at least 100 basis points over U.S. Treasuries, okay, that offer tremendous carry with very little volatility. And to answer your question, yeah, active management really adds alpha in fixed income. More than 50% of active managers on the fixed income side beat the index. Okay. The index is adverse selection in bond universe. So everybody that could take out very low coupon, long duration debt post COVID did. So as a bond index investor, you're stuck in that very low coupon, low dollar, long duration paper. Whereas you can go out and be buying that new issue 5.5%, 6%, very high quality coupon yielding paper that the index maybe is not able to take advantage of.
Well, it's fascinating stuff, Skyler, for sure. Appreciate your time to sort of navigate our way through it. And just as you talk, things can change next week. You never know. So good to see you again. Thanks very much for the conversation. We'll talk soon. Okay.
Appreciate it.
All right. There's Skyler Weinand. He is the Chief Investment Officer for Regan Capital.